It's time for the weekend review here at Grok Trade. I'm Mark the Meerkat in for Dez, who's out celebrating his second honeymoon after 25 years of marriage to his lovely out in California and enjoying those vineyards out there. For a little while, I'll just be not Dez, all right? We're going to take a look here at some charts. We're going to take a look at, I have a rant. I have a couple of rants of things that really upsetting me about this debt ceiling thing. So at the end of this video, I'm going to talk about those things. But before that, this is Memorial Day weekend. The real true meaning of Memorial Day is to honor those who have fallen, those soldiers who put their lives at risk and pay the ultimate sacrifice for it. But let us also honor those Gold Star families, the mothers, the fathers, the brothers, the sisters, the husbands or wives, and the children of those fallen soldiers. They live with that sacrifice to this day, while we all benefit from their sacrifice in the freedoms that we enjoy, especially the financial freedom. So let's not forget the meaning of this weekend. It isn't just the start of summer, and our gratitude is there for each and every one of them. So let's take a look here at the markets. Here we are, the daily chart on the SPY, the S&P 500 ETF. And here we are near back up here against the highs of the year here now. We did a pullback earlier in the week. The tears about and, a worry all about the debt ceiling. And then they didn't worry about it on come Friday especially. Kaboom on Friday here. And we're back up here to these highs there. So what are we forming here? We are forming, I don't know if you want to call this the beginning of a rising wedge or if this is, ascending triangle. It's tough to say here, but we are hitting some areas of resistance that we had before right at the 420 area. Now, one thing here, we get a higher a swing high and then a higher swing high. Down here, we've gotten a swing high and a higher swing high here, which means the trend could continue because odds are its trend could continue to the upside. Now that's there on the S&P 500 daily chart here. Let's take a look here at the Dow, and oh my, it's just it's been struggling here. Came down here, the 200 moving average. And fell to there. It dipped below it on Thursday, came right back up, closed at that area, and then took off from there on Friday. But boy, it's much weaker than we are in the S&P 500. And no convergence or divergence here on the MACD. Now, here's the big one. Here's the QQQ on the NASDAQ. Boom! This one has been a lot more bullish than the rest of the markets. And here we got a positive diverge. We have a convergence here of the MACD where we have higher swing highs, and we're getting higher swing highs in the MACD. What does that mean? That means possible trend continuation. That's nice. And it just broke out here, boom, way above that 340 mark. And again, it was a lot of the semiconductor stocks as well as the AI stocks that drove that, especially starting on Thursday with NVIDIA. And we'll show NVIDIA's chart here a little bit later. All right. Again, a little bit later, I have a couple of rants here I want to talk to you about what some things are going to affect the markets over time here but are not going to really affect it short term. They're lying to you on all those financial channels. They just want to have you be clickbait and be watching them all the time. Here we are, the small cap Russell, struggling compared to compared to the NASDAQ in this tight range all the way here from back in early March. It has just gone sideways here. Now we're just about at the end of the month here. We'll go back and look at the monthly charts here in a few minutes, but very, very tight range here on the small cap Russells. Part of the effect of this is the regional banks. A lot of them are smaller cap, and it could be holding that down as well. And considering that, here's the bank index, which is, what is bank? It's 720 small, all the regional banks in particular had the big crisis here, starting with the Silicon Valley and then the others, and they thought they had it solved. Nope. And now they might get, there's still some trouble in that area for the regional banks. And then we took at the overall financial sector, not just the banks. And that, look at it, is stuck in this tight, after the big drop, it's stuck in this symmetrical triangle. Just can't seem to get out of that area there. So, financing. Now, again, if you remember, we can't go anywhere without the financial sector going. We can't have a sustained gain without them over time, and we can't really have a sustained loss without them dropping as well. So right now they're down, so it's pulling down a little bit, but certainly not on the NASDAQ. All right, let's go back to the S&P 500, but let's go to the, we're going to go now to the weekly charts here, starting with the S&P 500. Let's see what we have there. We were in a symmetrical triangle here, and then 1, 2, 3, 4, 5, 6, 7, about 2 months ago, it's broke out from there and just been slowly climbing in a tight range. Finally here last week, and then this week, it was all the way down here. We can all the worry about the debt ceiling down to 410, and now it closed up here at 420 here on the S&P 500. We're out of the symmetrical triangle, but are we willing to break this area right in this here? All right, let's take a look here at the DIA weekly candles. And again, this big symmetrical triangle here, been in a really relatively tight range here on the weekly candles. Again, dropped all the way down here to the 50 moving average and pulled its way back up right to this 330 here on the DIA. That's the S&P 500. That's the Dow Jones Industrial Average ETF. And it's just kind of stuck on that lower range there. And then the QQQs, different story. It was in a symmetrical triangle here. It broke out here in mid-March. Then it was basing here for a long time. And then look at the last 3 weeks. Boom, boom, kaboom. Just an outstanding week here for it. Last 2 weeks, really. And it is a big here on the NASDAQ. Yeah, and again, the tech stocks, specifically the semiconductors and the AI stocks are driving that right now. Now then, let's take a look at this stock compared to what? Compared to the small cap Russell, the IMW, which is the ETF on the Russell 2000. Look at that. Looks a little bit different, doesn't it? Yes. Why? Again, a lot of regional banks are in this particular index. And again, this is weekly here. And look at, since that big drop, it's just been dancing on this line right here. So, you know, what's it going to do? Is it going to end up dropping again if we have some more banks that are in trouble? Or is it going to start to repair itself and take off again? Again, it's lagging the other markets. So we have a very divergent market out there. Tech stocks are on the move to the bullish side, while we have the S&P just going sideways. We have the Russell at low basing at lows. So yeah, it's been difficult. And on the bank on the weekly, you can see it dropped again, trying to work its way back up the last 2 weeks here. But you know, big wick at the top there. It hit that 20 moving average area on the weekly chart, not moving much. All right, let's go to the monthly charts now, starting with the S&P 500 here. Now the SPY here ran. Then right up here, starting in December, started to fall all the way through 2022. Did a little bear pullback. These are monthly candles now. And then started finally in October to try to make a recovery here. Was going sideways for 4 months. Now, we did have a positive month here last month. Actually, we've had 2 positive months. And again, we only have 2 trading days left here. And it's right there at that 420 area. It is now above the 20-month moving average there. So it's been a area of resistance. It's now starting to break above that. Again, 2 days for that one to close. DIA, Dow, it ran up, pulled all the way back. It's been running up, but it has not had a run back up here. It's still stuck in this area right here, almost a symmetrical triangle, just in a tight range. But then we have the NASDAQ. Boom, look at that. That's a bull pullback by definition, bull pullback and on its way up. Look at that sucker run right there. That is a nice move upward here. And again, it's been 1 month, 2 months, it's the 3rd month and a big month for it here. Again, just 2 more days until that one closes. But then look at that compared to this small cap Russell. Look at that. It's just struggling. It's just using this 50% Fibonacci retracement here as support area. And it's right back to it. It keeps wicking down to that area. And so that one is it's hurting. It's really hurting here. So again, with a divergent market, it makes it more difficult to do your swing trading and try to choose markets, try to choose stocks that are moving or not. Hey, a couple of things here before we get into some individual stocks. as well as the VIX. We want to talk about that. First of all, we are having a mentoring class. If you're not familiar with our mentoring program, you can go to groktrade.com, and go right here to our mentoring program. Now, what our mentoring program consists of is that we will coach you from this point forward. But we start with 3 days of intense training to get you ready so you know what to do. And here, let me just pull this up here. And there we go. We start with 3 days of intense training. And then we coach you to implement all that knowledge then as you move forward. And the thing with Grok is that we remain your mentors from this point forward. We just don't dump a bunch of information on you and say, good luck. No, that is not us. Now, in order to find out what our mentoring program is all about, you go through this metrics of videos in which it's about a 2-minute video. At the end of it, he asks you a question like, what kind of a trader are you? Are you a swing trader, day trader? And then depending on what your answer is, you'll then select your next video. And then at the end of that 2 minutes, it'll ask you another question. And then it'll choose a different, depending on your response as to what video you'll go to there. So after you go through the videos of information just you need to know for your type of trading, at the end, then you can make a decision whether you want to have a further discussion about whether or not our mentoring program would be appropriate for you. So again, that's at groktrade.com. Now, that 3-day of intense training we're having one coming up here in June 9, 10, and 11. That's a Friday, Saturday, and Sunday. We had to move it just slightly. Normally we're Saturday, Sunday, Monday, but this particular session is going to be Friday the 9th, Saturday the 10th, and Sunday the 11th, the 3 days of intensive training. And it'll be right online on Zoom, and so you can right from the comfort of your home. But you get some pre-studying done between now and then, going through our 201 on video training, and then we'll be live, and I'll be the mentor for that particular program. So if you'd like to join us, go ahead and go to groktrade.com. All right, next is, there you can see, he's asking you, I'm a beginning trader, I'm an experienced trader, or I'm a highly skilled experienced trader. So depending on your answer there as to which video you will see next, and then it'll ask you a question at the end of that video. So again, a whole matrix of videos, but it'll be custom for you by the time you get through those questions there. Alrighty, let's get rid of Des and let's get back to some individual stocks here. Okay, I'm back to the daily chart now, where each one of these is 1 day. And this is the VIX. This is the volatility index. If you're not familiar with that, that measures the amount of fear in the markets, in that the higher the VIX, the more bearish or how people are scared the market's going to go down. And so normally it's around 15 or lower, but for the last year and a half, it was 20 and above for the longest time, and now we've been below 20. But this week, what happened was, again, daily chart here, people worried about this debt ceiling thing. It ran up here. It actually was above 20 for a while, and now it's back down here. It closed right at 18, right, the 18 area, right at 1795. It's still a little high, but it's down back into the range it's been here, quote unquote, the new normal. So that's the VIX, just so you know that the fear did pop during the week. It's back into the range that it was. Still, it also tells you how much volatility there is in the market. It's still a little bit higher than normal. So it ends up being a little choppier, a little bit harder for those swing trades. It's been, actually, the last year has been the most difficult. I've been swing trading for, 15 years now. This is by far, the last year has been the most difficult for swing trading, just because the market has been so volatile and so hypersensitive to every little tiny nuance of news that they'll dissect, syllables in a word that somebody says and then make a big move as a result of that. We got to take a breath, pull back a little bit. And when I get to my rant, we'll talk more about that later. Okay, let's look at some individual stocks. Let's look at the manga stocks. The Mang, it used to be FANG stocks. Well, now, instead of Facebook, it's now Meta. So it's Mang stocks. And then we got to add in a couple others here. So let's take a look here at Meta. Here's Meta. And again, look at that. It's been recovering here after its big drop. And look at that, even on, new highs here. Boom. It's a nice big run up here again. On earnings, it broke out, pulled back just a little bit. Not unusual for that to try to fill the gap a little bit and then work its way back up. And here's a Microsoft. It's been on fire as well. Again, part of this is that they're calling this an AI play now, an artificial intelligence AI play. So here it was basing for a while, broke out, pulled back, and then boom, took off again. Apple up to 175 now. Again, just been a steady eddy here. Look at that, from 124 here at opening, now up to 170. That's a nice little 50-point jump there, over 40% for the year. And then we got Amazon here. Again, it had its earnings here, pulled back, but then took off, and now new highs. Look at that, pull back, boom, on Friday, back up to 120, up to 120 after its big split last year. Here's Netflix. It's getting back up to this range that it was back in here in January. It pulled back, not up big for the year, but now back up here trying to make out new highs for the year to date. And then we got Google L here. Look at that, just flat. Even after earnings, it was still flat until kaboom on this date. And now we're right back up here at 124 on GOGL. And then we've got now NVIDIA. Here's the new hot one, new hot property, up over 100% this year so far. Boom, look at NVIDIA here. Look at that. It was a $145 stock at opening, and now it's at $389 close here. And I had earnings on Thursday, and again, they made a lot of movement in AI. Kaboom, and it brought the whole market to an explosive type of region. And then, of course, we got to talk about Tesla, not part of the FANG stocks per se, but everyone's looking at that. And it's just been hanging around this $200 area. It had, back in February, they had some predictions that it was going to go to 500 in the next 3 years. Yeah, it's just been hanging around this 200 level for quite a while now. Still relatively strong. All right, you might notice some of these buy and sell things on here. These are the algorithms that we offer here at Grok Trade. If you're not familiar with those, again, you go to groktrade.com, go to Algo right there, and it'll talk about our algorithms that are available, a video about what they are and what they can do. We have 4 different ones that we offer. They each do something a little bit better. One on the ROC, picks the hard rock bottoms, and other ones tell you when to buy, when to sell. So anyway, if you're interested in that, that's at groktrade.com. All righty. What's next here? All right. So much for the commercial break. All right. This is it. This is my chance to rant here. I'll tell you what, this whole debt ceiling thing it's a fugazi, folks. Well, number one, we are not going to default on our debt. We are at record income right now, record income into the government. That's not going to stop. And number two is that constitutionally they must pay our debt first, and then and things like Social Security and all that is still going to be paid. Now, yes, may there be some government shutdowns until they get something solved? Sure. But every time we've ever done this, we've had the government shutdowns, but guess what they've done? They've retro-paid people, so it's a paid vacation for the government workers that might get laid off. All right, that they're going to be made whole. That's not an issue. So that's all going to happen now. And again, people are saying, "Oh, we're going to have a 50% drop in the markets if we default on our loan." Well, it's not going to happen. That's scare tactics, and both sides have done it. Back when Trump was there and we up against the debt ceiling, the Democrats were screaming all this stuff, and now now the Republicans are screaming things. It doesn't matter. Both sides are not totally telling you the truth. So again, you have to look at what the numbers are. So if you look at one side, they proposed a budget. What were the numbers on that? They're gonna. Here, I got it up here, right here. That 2024 budget is going to increase tax revenues by $4.8 trillion by canceling the Trump Tax Reduction Act. They're just going to cancel that. And of course, they're going to just focus on the rich and only the rich. Well, yeah, great. So, but then they're spending, they say, oh, let's see here. The spending is going to be increased by $1.4 trillion from its already obscene level that we are at right now. And they say, Ben, we're going to reduce the deficit. Yeah, we're going to reduce the deficit. No, you're not. You're going to reduce the amount you're putting into the deficit over the prior year, but it's still going to be $2.5 trillion going to add to the deficit of $31 trillion already. So it's insane. So see, when they say they're reducing the deficit, they're not. They're reducing the amount that's going to be going to the deficit. It's still $2.5 trillion added to the deficit, folks. So when they say they're not doing that. Now, on the other side, they're doing the same thing. They're saying, well, we want to propose these cuts. Well, they're not cuts. They're reductions in how much how much the increase is going to be. All right. It's again, they're trying to paint it their own way. And, both sides are trying to manipulate the system so that they can have a quote unquote controlling interest in the thing. But who's going to suffer? All of us is going to suffer until they get this thing done. And again, what's the impact on the market going to be? Probably minimal. And even if it does pull back a bit over this one issue, it's going to recover right away. It always has every time this issue has ever come up. Now, the longer term here, there are several concerns here. In September, we've got the college loan, they've been all halted here for the last 2.5 years. Well, that's going to come off. So all these people who've been not having to pay on their student loans, and suddenly if that comes up, they're going to have to start paying at least a minimum on that. So that can be a major impact for some people who have these huge outstanding loans. And then we have a bit of a credit crunch here as well. Yeah, we've had a few of these, what I'm going to call designer banks out there. Out of Silicon Valley, the depositors there were, billionaires that are putting their money into that. And so what does the Fed do? They come in and the federal government. So what does the federal government do? They come in and they forgive the loans. Yeah, you're protected up to $250,000. Well, we're going to get everybody is okay. Michael Zuckerberg, he had all the money from Facebook sitting in there. It was more than $250,000, right? And they got made whole. But did you also know that he had a loan, a $5 million loan for his home at 1% interest for 30 years? Wow, why is that? Why does he get the special privileges? I don't know. And so he should definitely be made whole. No, that's what's going on. But these smaller regional banks, they don't have these huge glamorous depositors, but they have depositors over 250. A lot of small companies, right? All the small companies out there, the small businesses have their accounts here. Will they be made whole if their regional bank goes out? But they're saying, well, maybe probably not. You only get to 250. Well, man, if our payroll is $2 million a year, what's going to happen? So it's going to force them to go to the big banks, because if you're a big bank, then they are going to get covered beyond what the normal Fed requirement is. So we're setting ourselves up for all that. So again, some of the bigger issues, got the student loans, you've got, and then you've got inflation. I mean, good grief. We keep causing the inflation. We keep adding to the deficit. That's going to keep adding to inflation. The Fed keeps raising the interest rates. That's adding to inflation, folks. Think about it. They've gone up 5 percentage points. 5 percentage points in the last 2 years here now, right? Have never gone up that high, that fast in the history of the Fed. So, what's going to happen? It's going to continue to cause things to expand. But you know what? The federal government doesn't freaking care. Why? Because tax revenues are based on what? How much your income is. So if you keep getting, wage increases or the cost of goods on sales, on sales tax, right? If the cost of goods is going up, they're getting more revenue. They love it. The government loves to have inflation. They say they don't, but they love it because they get met with more revenue, then they can go spend more money. That is not in the best interest of us, the individual citizens. I could go on and on and on here. I know I'm kind of going off on different tangents here. But the other thing that with this Fed, here's the real fugazi here. The Federal Reserve cannot control the price of gasoline, cannot control the price of your food that you put on your table, cannot control the cost of your electric bill. Yet they're saying, "Oh yeah, we're gonna cure inflation by keep raising the interest rates." Yeah, what they're doing is they want to break the economy. Now, do you know that every time the Fed has done this, they've done it too late, too strong, and for too long? Every single time. They have. Do you know how many economists they have at the Fed? They have 4,000 economists. And remember last year they told, "Oh, this inflation is just transitory." And then it went what? It didn't just go up. It went parabolic. That's right, folks. So they don't know what they're talking about either. And again, that's the monetary policy. But then the fiscal policy, of course, is our Congress and our spending, and it's out of control as well. And they just keep adding trillions and trillions to our debt. Well, if the debt's going up and then the interest rates are going up, we're now paying 5% more. We're actually 5 times more on short-term interest than we were 2 years ago. Well, and we have this deficit there. Well, guess what? The interest we have to pay on that is going to go up, by 5? That's going to be most of our budget, the rate we're going here. Anyway, so I'm going off in here, just a little bit of my rants here. So again, don't listen to those talking heads. They just want to get you to keep tuning in for the latest and the greatest and all the scary stuff. There will be a debt deal. They'll get it done. And but then be on the lookout for what's coming down the pike here. We got several issues facing us here. And it's not over. Now, does that mean you should go out and short the market tomorrow? Absolutely not. In fact, one of the trading principles that we teach in our mentoring class is you set your trades and let the market come to you. You don't anticipate what's going to happen. You're proactive, and when it does make the move, then you're ready to go there. But don't get in short now, because you could end up losing your short, because we know it's probably going to go down, but we just don't know when. And how severe it's going to be. I mean, you got people out there predicting a 50% drop in the markets. Give me a break. That isn't going to happen. But could we pull back 10, 20%? Sure. But then that's okay. From a swing trade standpoint, I'm just going to sit on my hands if you can't go short. And then I'll get bargains when it starts to go back up again. But when you get confirmed back up to uptrends. Well, this is Mark the Meerkat. Thanks if you've been hanging around all this time. I'm sorry, I had to get some things off my chest. And I probably didn't explain it very well, but clearly out there. Go to different sources if you can. And in fact, I want to recommend a book to you, and not about these topics at all, but just a book in general. If you're a trader out there, called The Best Loser Wins by Tom Hogate. It's a fabulous book. I'm in 2/3 of the way through it right now. It actually is an echo chamber for what we teach here at Grok Trade in our mentoring program. But I'm gonna finish off this whole recording here by talking to you about, or giving you a quote from that book. And that is, he says, control your mind and you'll control your future. Trade well and may your winners run.